you're very, very welcome to the June edition of Practice News, a packed session as ever. And I'm going to firstly give you our headlines for the early birds this morning. You heard me talk a little bit about this, but if you've joined late, just a quick overview of what are going to be the main segments we're going to have today. Firstly, delighted to have our colleagues from Professional Standards who regularly join us, usually every 6 months or so on Practice News. And so this time we have Karen Flannery, Head of Projects, and Anne Cullen, Head of Audit Monitoring, and both have joined us in the past in Practice News. It's been going about 4 years now. And Anne is going to talk to us particularly about monitoring visits. So it could be anti-money laundering or audit, just key things, what the process is, and what issues we see repeated, and that will hopefully give you insights if you're subject to a monitoring visit and give you food for thought there as to how to prepare. Also as well, Karen is going to talk to us about some changes that are coming up on investment business, PI cover, indemnity insurance cover, and so on as well. So really looking forward to that. Company law and CSRD, we're delighted to have Orla O'Brien, Assistant Principal of the Department of Enterprise, joining us along with our Professional Accounting Lead, Dee Moore, and a familiar face to many of you at about 10 to 11. And CSRD, its implementation of Irish law, Department of Enterprise have been working very much so in the last year to 18 months to transpose the very detailed requirements, and there's been some consultations and so on into Irish law. It's coming up very soon, but also audit exemption, losses with relation to filing and so on. That second chance, Orla will talk about that as well, and some other updates to the Companies Act 14 that are planned. Yes, as you mentioned, Conal, we're going to have yourself and Damien, a recorded session, just a few minutes this time on the current investment markets updates, and that'll be about 20 to 11. I know favourite topics for many of our attendees is our UK and Irish tax updates. Delighted to have Gerard O'Sullivan, our Republic of Ireland tax lead, joining us at about 20 past 10 to give us all the latest happenings, pre-budget submissions and so on as well on the tax fund for the Republic of Ireland. And then we'll have Leon Shadoran joining us for her session towards the end of the webinar at about 20 to 12. And I'm going to give a few news items and just more guidance really, and helping you on what recent webinars and guidance materials we have there on very complex issues. Just checking my phone a minute ago and somebody was asking and sending me in a query on AML. So we're going to point you to some guidance and materials there as well. So Conal, if you can click ahead again. Now, most of these are familiar faces to you. Delighted to have Dee joining us again, and Gerard, as I mentioned, that is Karen and Anne from Professional Standards. And there's Leoncha as well. For anybody who's new here, my name is Jeremy Toomey. I'm the I am the Practice Consulting Manager, giving myself a promotion. And I'm delighted to be joined by Conal Kennedy, Head of Practice Consulting. So not after your job, Conal. And but basically, we're obviously working here in the Practice Consulting team for a few years. So great to be back on this webinar again. So Conal, if you can click ahead again.
Absolutely.
Yeah, as I mentioned, delighted to have Orla O'Brien of the Department of Enterprise. Orla is an assistant principal in the Department of Enterprise, and she works in a unit that works particularly around updates to company law, accounting and audit requirements. Of course, a lot of these come in through EU requirements and such as CSRD and transposition into Irish law, but we liaise with such bodies as our own institute, with IASA and so on as well. So a very important role to accountants. So Orla is going to, as I say, talk to us about CSRD and other important changes that she'd like to make you aware of. If you can click again. Yeah, delighted to have
a bit of a delay
Damien
on the slides there.
That's all right. We're delighted to have Damien with us again for a few minutes. I know Damien, familiar face to many of you, is a fellow chartered accountant as well, an investment expert with AccuVest. And Damien, and we're delighted to have Damien's support and also the support of the firm here as our webinar sponsor. It's very much appreciated. And I know from getting the feedback, a lot of our attendees as well really value, I suppose, just getting those insights on, what will be the impacts of interest rate changes, investment markets, things that we all like to stay on top of, but it can be difficult. Conal, if you can click ahead again. Yeah, who are you this morning? As I said, over 550 bookings last time I looked, so that's a very consistent level. One thing I'd like to say, these figures, we're seeing actually a growing proportion of people, I think, from members in business, up to nearly a quarter now. So you're very welcome. This is primarily a practice show, but obviously people maybe who have maybe come back or maybe have moved between practice and business and so on. So hopefully you find it useful as well. I think the tax updates are useful for everyone. And of course, we have an audience that reflect our own institute membership drawn across from Northern Ireland as well, a few from the UK. And that's just the demographics. So I think it's safe to say every county on the island of Ireland covered there. Our agenda, I've given you some quick overview. I'm going to have a couple of updates now in just a couple of minutes on the news items. Then Gerard will join us for tax at 10 for about 20 minutes. Then Damien and Conal will have a quick recorded session on investment updates. Then it'll be Dee and Orla talking about company
Jeremy,
law and CSRD.
I can't hear you. So that maybe my computer or your, I think it's my connection is unstable.
Yeah, that's okay. Can you hear me now?
I can hear you. I think it's just my connection, but
that's okay. That's perfect. No, that's okay. And so Dee and Orla will be joining us at 10 to 11. We'll have a professional standards update with Anne and Karen at 11:15 or so. All of these things could go a few minutes either way. And then the UK tax update at about 20 to 12. We always try to take questions as we go, so please don't be shy. The Q&A function, if we can, I know tax or popular sessions, Gerard will try to give you an answer on some of the things. If they're very detailed, sometimes we have to take offline, so you might be best to contact us at practice members and so on. We'll tell you that, so please do be patient with us. Go on, if you can click ahead again. Yeah, the disclaimer, very important for this one. 2 hours, we're trying to cover so many topics, dipping in across all regulated sectors and so on as well. So it's always important to go to the company law and guidance, and we are trying to distill so much into a couple of hours. And yeah, it's a legal requirement. We have to drop this in as well. So Conal, click ahead again.
Yeah, I'm having connection problems here, so I'm going to probably run out now to see if I can sort them.
That's okay. That's okay.
So you want to talk about AML first anyway, Jeremy?
I am. I'm going to talk about AML first and our practice updates for June. And what I want to make you aware of is we have some AML updates to our technical hub. I'm sure many of you are users of our technical hub. It was put in place about, if you click to the next slide, Conal, it was put in place about 3 years ago now by Dee and the professional accounting team. And it covers financial reporting, covers auditing, company law, but also AML. And of course, anti-money laundering and sanctions has been so much change in the last couple of years, UK, Ireland, and globally, particularly with the war in the Ukraine and so many sanctions coming in there and Russian-related sanctions. So in recent weeks, Dee and her team and Lady Hampen, who has been on past Practice News webinars, have been doing some updates to the resources. On the PDF, those 2 links there are live, firstly to the AML resources pages and then to the technical hub for the wider information. But just to make you aware of a few changes, on the fraud and economic crime side of the actual hub and of the information we have there, there's been new pages put in with relation to what is fraud and economic crime and current legislation for Ireland, but particularly for the UK. There's been 2 acts, as attendees of our past webinars know, brought in 2022 and 2023 in the UK with relation to economic crime, fraud, corporate transparency. They're going to result in big changes to Companies House, already starting and down the line with filing, and particularly even with filing of financial statements for small and micro-sized companies, and that'll be coming up in a year or two. We have guidance documents as well, issued just in the last couple of months. You'll have seen us highlight those in previous webinars. They're all at that link there. So if you, even if you're based in the Republic of Ireland, only have a couple of clients in the UK, gives you a great overview of what's happening there. And particularly, of course, if you are based in Northern Ireland or elsewhere in the UK, it's invaluable material to you. We also have our reporting requirements materials have been updated, and this is chiefly because of the new National Crime Agency, new SARS portal. And the new SARS portal has been fully in operation since just this spring past. They've been working on it and developing it over the last year or so. Again, we will have webinars coming up that I'll mention, just to give you a bit more of an overview on this. But that is the chief change there. But one of the things I really want to talk to you about is information on AML developments at an EU level. And there has been some changes here. We're seeing really the 6th directive coming into and coming through with the necessary steps at an EU level. So I'm going to tell you a bit about that. Conal, if you can click ahead again. Great. Now, back in late April, the European Parliament approved a package of laws, and the whole idea here is actually two regulations and one directive, and these is to improve the EU's toolkits where they're seeing gaps with relation to AML compliance across all the 27 countries, to harmonise them, set up a new regulatory authority, but also, yeah, to bring into place through the directive, the sixth AML directive, which will allow different states to introduce these requirements into their own laws. What's going to be the changes down the line when they are introduced to Irish law and any EU country law? We're going to see, and this has been a theme in past directives as well, more instances and more definite requirements with relation to the use of enhanced due diligence CDD measures for your actual clients, and particularly for high-risk clients, and checks on their identity and proof of wealth. We're going to have more provisions on ultra-rich individuals. These are people with more than 50 million of assets. Hopefully, many of you here today have some clients in that area, but many who may not, of course, but that's what that's going to be. And we're also going to see that EU-wide limit of 10,000 on cash payments. That's something that isn't, I think, applied in a harmonious way across all countries. And we're also going to have more targeted measures with relation to financial sanctions, and where loopholes are being exposed with relation to the implementation of sanctions over the last 2 years. So, Conal, if you can click ahead again. One other part of it, one regulation is going to set up what's called this anti-money laundering and countering the financing of terrorism (AMLA) body. This now is going to be based in Frankfurt. You might remember the Irish government put a lot of effort into bringing this in an EU competition to Dublin. Didn't work out, unfortunately, but this body now has been decided is going to be based in Frankfurt. It's going to be primarily involved in coordinating national bodies and national countries with relation to their implementation of AML requirements for the financial services sector. Who's to know in the future will have a wider remit as well. But just to be aware, this regulation brings into place, and work is, I understand, at an advanced stage to establish this in Frankfurt from the beginning of 2025. The overall package, as I mentioned, two regulations, one directive. The one directive is going to bring in all those potentially into Irish law in a couple of years, all those requirements, and then those harmonising and the new regulatory requirements there as well. So that's what the overall package is. I wonder if we can click ahead again. The next steps. So when the Parliament approves it, it goes to the European Council, who would have met just at the end of May, just last week, and they have actually approved this. So that's the final step at an EU level. It's going to then be published in the EU Journal, I'd imagine fairly soon, probably before the summer break. And then the regulations will come right away, as they do, into the laws and requirements. The directive, which is going to bring about those CDD changes and different things, that has to be transposed into Irish law and the law of the other countries. There'll be a time window of 2 to 3 years there. So you're going to see a gap at this coming up, but that's what it is. And as I said, the new body, the regulatory body for financial services, will be in Frankfurt from mid-25. If you want to learn a little bit more about AML reporting, and it can be, I suppose, a challenging area, we do a lot of webinars in this area, but we're going to focus on reporting in our next webinar, and that's going to be on Wednesday week, the 19th of June. It's for both the Republic of Ireland and for the UK, all is a popular session. So if you want to get up to speed in that, and particularly if you're the actual money laundering compliance principal reporting officer, it's very important to attend such webinars. Now, we also do have a new interactive on-demand training session. This is more for new people in your office, or people who mightn't be a compliance officer, might be your new junior staff, might be people who work in administration inside. It's a 1-hour module. You have an assessment at the end. It's fairly easy to use. I've been involved in development this myself over the last few months. So please do click that second link as well. It won't primarily be focused on your requirements as the money laundering reporting officer. You do need more detailed webinars and training in that area. But just to give you that offering for the more junior staff members and the more basic offering as well. Conal, that's, I think, as much as I'm going to say on money laundering. My next area is SCARP.
Just before you go, somebody has asked, will AMLA be relevant for practices in Northern Ireland?
Will AMLA be it's primarily financial services, and for Northern Ireland, Northern Ireland and the UK is not in the EU. So I imagine not, but you do have what I would imagine in the UK, is you tend to see both jurisdictions try to match each other. It's very important to have a strong AML regime, and I know that even with the Brexit process, the UK has assured that its regime will be at least as strong as anybody else in the world, but even better, as I say to you, to win business for the UK. So you won't have AMLA. But you will have you may have something like that, or you may have something like that, or something similar put in place by Treasury or something, or looking how they rejig it. So just to be aware of that. And if you are based in Northern Ireland and you have clients in the financial services sector in the Republic of Ireland, they will be impacted. So that's as much as I can tell you in the moment on that.
Okay, all right, thanks, Jeremy. Now SCARP is the next thing on our agenda.
Yeah, SCARPs. I'm sure many of you, particularly in the Republic of Ireland, are familiar with SCARPs, with the Small Company Administered Rescue Process. Was much heralded when it was launched towards the end of the COVID period in 2021. The whole idea was to ensure that there was a cheaper process than examinership for many small companies, particularly in hospitality, retail, that really struggled during COVID. And there was worry about a wave of insolvencies coming after COVID and coming after the supports from the government when they receded. It's been very slow uptake, I imagine, in the first couple of years. There was a webinar just last week on the 29th of May by David Swinburne and Philip Marr of the new Forvis Mazars, along with our colleague Laura Michelle Moore in the professional accounting team, who specialises in insolvency. 1 hour free webinar, and the whole thing really is to give an update with relation to where SCARP is at. If you have a company now, particularly with the revenue phase payments arrangement after coming into play, that'll have to start paying back money, it might become the really truth time for some of your clients. They may be thinking of, how do they restructure? Can they avail of SCARP? I understand from the webinar that just there's been 64 companies going either through or completed the SCARP process, and I think about 40 something successfully. So it is ramping up a little bit. If you want to learn more, the free 1 hour recording there is at the first link at the bottom of the page in the PDF. And we have lots of materials actually that are free, from technical materials, practice news, even more Thrive and CA support and health and well-being on the YouTube channel. 750 videos I counted, so there's a lot of stuff there that's free and would maybe help you at your CPD and so on as well. So that's that, Cornel, on SCARP. I think the next one is for yourself, our new Solicitor's Toolkit.
Absolutely, yes, indeed. Now, there's been a lot of change in this area. There have been new regulations made in 2023, new Solicitors Accounts Regulations 2023. They are relevant for periods commencing, this is these solicitors reporting periods commencing 1 July 2023 and thereafter. So therefore, in other words, for periods ending 30th of June 2024. So if going forward into the second half of this year, you are doing a solicitor's accounts reporting engagement, then it is likely that these new regulations will be relevant to your engagement. A lot has changed, I have to say. There are now 4 balancing statements, including the final one, instead of the previous 2 balancing statements. They're quarterly. The report is due after 5 months, so don't miss your deadline. So you need to look carefully at that. There's a lot of change in it. For example, around the 4 balancing statements, the reporting accountant is required to do, in effect, cut-off testing around each of those, around a selection of those balancing statements, at least one. So it's, and probably more. So look, there's additional work involved. There are additional requirements there. For example, there's an option to report if there are deficits which aren't being made good by the solicitor, or if there's concealment of deficits. There's an option to report early and separately by the accountant. So that's in place. The solicitor needs to consider whether there's any undue delays in dealing with client affairs. There's a requirement to it's a new Appendix 6 to the report, where any amounts outstanding more than 2 years on client accounts need to be reported upon. Other small changes, they're small unless they happen to apply to a particular case you're dealing with. For example, estates. for deceased persons are now part of client money. They're not part of trusts anymore. They've been moved. The idea being is you don't need to open up a separate bank account because that was causing problems. And then there's a sort of a regularization of something I think was happening anyway. In that a solicitor is now permitted to lodge personal mortgage drawdowns to the client account, which sounds strange, but the reason for that is because sometimes lenders insist that the money is lodged to a solicitor's client account, and the solicitor's acting for themselves, and that's the only practical way to do it. So it's been permitted. So as you can see, there's a lot going, and that's just a small selection, I have to say, of the changes. That's just a flavour of the changes which are brought through. I mean, we actually put out a course there on the 23rd of May with Rory O'Neill from the Law Society. We also have Anne Sykes from the Institute, and John Callahan from Moore. It was, I have to say, of the course that we've given, we obviously monitor the feedback from courses. It was some of the strongest feedback we've ever got from on a course. It really seemed to land very well with the people who attended it. And we got we got a great attendance. So I think that's a course we'll probably run again later on in the year. So if you're looking at, I think, Jeremy, is it November? We're thinking.
Yeah, we're looking at November for it. So we'll look at after tax deadline time, and as there's great feedback there. And I think for a lot of, just with the timelines you mentioned, a lot of people will begin to use these, or have to use these new regulations for their solicitor clients, probably coming towards the end of the year and into 24. So it's it'd be a good time for it again.
Absolutely. And there's obviously this toolkit, which I mean, I think you need to use a new toolkit. We'd recommend our one, naturally, which we've just published on this, and which was where there's an early bird offer running until the 14th of June. So if this is something that you're going to have to buy anyway, we recommend you buy it now so that you can avail of the early bird. So that's the whole area of solicitors. A lot of firms have one or two or more solicitor clients. They are higher risk clients because they're obviously dealing with other people's money in their client accounts, and therefore we recommend that people take it, the whole area very, very seriously. Do your CPD, get good procedures in the area, and just bear in mind a lot of change. So there we go. So that's that. One question has come up in the questions. I'll just do a quick look, see if I can just.
It's asking about the accounting periods, and it's asking, do the old rules still apply for an accounting period ending 31 December 23? Yes, indeed, they would. These new rules apply only for periods beginning on or after 1 July 23. So you're really, unless you have a solicitor who has a short period or different things. So if the year for them ran to December 23, it's the old rules.
Absolutely. And that course is available for download also, if you want to download it from our shop. So if you haven't done a course in this thing, you need to do one. I'd strongly recommend. Okay, somebody else asked, any update on ACA and CPA joining up? Will they change the overall organization once this is completed? Well, look, the answer to all that is yes. I mean, obviously, I think there's going to be fewer changes on the chartered side than the CPA side, given that chartered is a significantly larger organization. But yes, we're going to change. There are going to be changes in how we do things. We're delighted to have the extra resources of the CPA team joining us, and in our initial engagements with colleagues in CPA, we've looked at what's the best of both sides. How can we enhance member services? So look, watch this space. What we're going to say, we're going to be doing more on this. I think time doesn't allow us to go into detail on that question, but thank you for the question. And by all means, that's where we're going to be going. Now, the next thing we'd better move on to now is to take a couple more of those questions as we go along. But the next thing we want to move along to now is practice matters. Now, Jeremy, you're going to tell us a little bit about that.
And just to say to you guys, Practice Matters, the June edition, will be issued very shortly. I imagine next week. And we always just want to highlight, just watch out for your emails that we issue now by email. With the old paper version we haven't put out in a couple of years now. Still get asked about that. It's obviously still in the format you can print it out. So by the end of next week, just watch out for a Practice Consulting email, and you will get your latest edition of Practice Matters. Some of the news stories that I've covered there are actually covered in this, and obviously the tax in the UK. So you're getting the insights still here this morning. And if you want to get past editions, just click that link there as well. And that's a cover from back in April. So yeah, be on the lookout. And I think we have a new edition of Accountancy Ireland that went out probably in the post at the moment, the hard copies, but the electronic version I know went out earlier this week. So Conal, without further ado, that's our news items. As usual, we're a couple of minutes over, but it's good to have the questions and so on as well. And hopefully you guys found it useful. Garrod, we're moving from Belfast across the island to Cork. How are things with yourself?
Jeremy, all's good down in Cork. I think we're slightly cooler weather at the moment, which suits me. I think I got a bit burnt at the weekend there, so yeah, we'll welcome a slight cooler.
It was a nice weekend. I was down at the Costa del Kerry myself now, so it's
Oh,
very, very nice, as I say to you. So I get around. But basically, anyway, Garrod, I know you've had a busy few weeks in your team with budget submissions, a lot going on. I'm going to shut up and just give you the floor.
Jeremy. So yeah, it's been a busy few weeks and months again now since the last practice news. So today, what I want to focus on is the annual pre-budget submission. I want to talk about the significant change to how revenue view the employment status of workers following the Supreme Court decision last October. Would have mentioned this in the last practice news, but now we have guidance, so I'll discuss that. Just to mention an update on the EAS guidance, and then just to fill you in on the work we continue to do at TALC and what's going on there at the moment. So just to start with the pre-budget, so if you can move on to the next slide there, just so that people can just to have the stuff up. But anyway, so this year's pre-budget submission. There's a link to it there in the slides, right? So you'll have got that this morning. We have focused on the SME sector, so it's supporting the SMEs is the title for this year's submission. Barry, the sound is patchy. Sorry, 2 seconds there, Barry. Let me see if I can
change now. Hopefully that's a bit better. I just changed to the computer microphone. I have these earphones in, so if the sound has improved, you can much better now. Okay, thanks for that, Barry. Appreciate it. So this year's pre-budget, as I say, has been framed around SMEs. I suppose the rising costs of business and the complexity of doing business, has been raised through the tax committee and in discussions with members across the country. And I have met with members obviously in Cork because I'm based here. I get a good chance to reach out to members here and again, just around the country, anecdotally and otherwise, obviously in the news. I think it's been great to see the Department of Enterprise, Trade and Employment business support package. I suppose part of all these measures are obviously always welcome for business, but obviously there can be difficulties in claiming some of these reliefs. We saw this last year with the temporary business energy support scheme, a very good idea, but it ended up being, I suppose, difficult and cumbersome. And this is sort of what we're trying to say for businesses. Time is precious and time is valuable to all businesses. And if we're going to introduce reliefs for businesses, they need to be accessible and understandable. So that's sort of a general point we made throughout where we can. The other measures we're raising are around the cost of childcare and the capacity in the childcare system. So this is building on work by Crona Claus here, Director of Public Affairs, and there my colleague Stephen Harry, our public policy lead, who have put out a very strong paper last year on childcare, and we've echoed a lot of the sort of tax related measures, and also we're suggesting a tax credit for parents who wish to return to work. So I suppose the key thing here being just we need to encourage, I suppose, people we need to support people who want to have to raise families, and but at the same time we need to support people to get back to work. And there is, like a lot of areas of the economy, there is going to be a lag before capacity, I suppose, catches up with demand. This government have been very open about this because of the lack of public spending, particularly during those austerity years. But you know, I suppose we can see it in housing. We are starting to pick up. But you know, housing obviously being another area of a pre-budget submission where we need to see government just continue with any measures, either tax related or otherwise, to stimulate the supply of new houses in particular. And of course, we also need to ensure that there's sufficient funding for retrofitting houses. Also, because obviously there's a significant body of houses that need to be upgraded to meet the energy requirements. So another area we are looking at, two areas two areas that I think are also very important for both at the SME sector in Ireland, I suppose, from a global and international perspective, is to reform our personal tax system. So last year we responded to a public consultation on personal tax reform. So we have simply referred to that document in our submission and echoed a lot of the statements there. We still continue to support the introduction of an intermediate rate of tax, the merging of USC and PRSI, and potentially, you know, I suppose we'd like to see a system that does move towards a single income tax, as opposed to, you know, the three different rules we have for calculating the different taxes: PRSI, USC, and income tax. Also, we're looking at discrimination against service companies as professional service companies. So things like access to relief for investment in corporate trades, access to things like HEAP scheme, and I suppose just the general discrimination against professional service companies in terms of the professional service companies surcharge. And I suppose the sense here is, you know, a lot of these rules around professional service companies would have been introduced in a different era, and we're moving into a new time now, and we're sort of trying to bring out some of these points. So the submission, I think, is certainly, I suppose I would encourage, if you have time to read it, certainly to pick out some sections that might be particularly useful to you. We are going to, just to say, we will be meeting with the Minister for Finance in July to discuss part of the pre-budget submission, and also generally just to really focus on, I suppose, the lay of the land for SMEs at the moment. So that's coming up as well. So that's sort of some of the work on our pre-budget at the moment. Yeah, I suppose we'll see now what comes through in this year's budget. So the big meat today, the meat of today's discussion really should be around this revenue guidance on the employment status of workers for tax purposes. So just to acknowledge there, I did see Johnny there about that the links don't seem to be working. So look, we'll try and rectify that. So let me come back. We'll try and get back to that later. But just to say for now, right, you can access this guidance, the revenue guidance, on Revenue's website. So if you search that into Google, say with revenue, that link should come up pretty quickly.
If I can just say to you there, so obviously the version of the slide deck that I sent out yesterday wouldn't have your links in, but the version that Emma has dropped into the chat function, guys, if you're there, is the latest version that would have those slides with the links in it. So I think somebody's working off yesterday's version of the slides. That's the only difference there. So we'll send those slides all out again afterwards too.
Super. Oh, that's great, Jeremy. That's good to know. Yeah, okay, great. So you'll have the links, which so you don't have to, you can avoid the Google, so that's good to know, right? If you're, so just to start off by saying with Carson, if you are working in the area of employment taxes, if you in your company, you regularly engage independent contractors, you need to familiarize yourself with this new guidance. This guidance was issued, a draft of this guidance was issued in March. We had sight of it through the Tax Administration Liaison Committee, the TALC forum. The Direct and Capital Taxes Subcommittee was the particular forum where the document was shared. I have included in a recent tax news story a copy of our feedback on that initial draft, and you will get a sense that we have sort of a different view, perhaps, to revenue in some matters. What I would say now is that the key statement, I think, in the guidance and I'm going to directly quote this. So this is what Revenue are saying. As outlined throughout these guidelines, there are a number of workers across a number of sectors who will need to be treated as employees for tax purposes, where previously they have been treated as self-employed. It is essential that businesses urgently and comprehensively review arrangements with all workers and determine their employment status for taxation purposes. Where a business previously treated a worker as self-employed rather than as an employee, and the review of these arrangements by reference to the five-step framework indicates that they are employees for tax purposes, the business must now rectify that position by treating the relevant workers as employees and operating PAYE. And later it does say that Revenue do expect a significant number of workers who hitherto have been considered self-employed independent contractors may need to now be reclassified as employee. So the five-step framework talks about, does the contract involve the exchange of a wage or other remuneration for work? They're calling this the work wage bargain. So obviously, to be a worker at all, for there to be some relationship, there has to be consideration. So for there to be any sort of contractual or obligations between two people, generally there has to be an exchange of something, and more often than not, that's cash. Or if so, is the agreement one pursuant to which the worker is agreeing to provide their own service and not those of a third party? This is more commonly known as personal service. So this is looking at, I suppose, what would previously have been considered things like substitution and the extent to which I can subcontract my duties and things like this. If so, does the employer exercise sufficient control over the employee to render the agreement one that is capable of being an employment agreement? So these are like the three initial gateways. So is there pay? What's the level of personal service I give, and what's the level of control exercised over me? Then once these three initial tests are satisfied, then you're generally considered, if there is, what we'd say is, if there is pay, if you do have to provide personal service, and if there is a sufficient level of control, then I suppose generally you are likely to be considered an employee. If these three requirements are met, the decision maker must then determine whether the terms of the contract between the employer and the worker, interpreted in light of the admissible factual matrix, having regard to the working arrangements between the parties, are consistent with a contract of employment, or with some other form of contract having regard in particular to whether the arrangements point to the employee working for themselves or for the employer. So all the circumstances of employment is explained in more detail in the guidance, but this is essentially saying let's look at things from an overall perspective. And this is what they looked at in the Carshan case. So in the Carshan case, you had the Domino's workers who were initially who signed up as independent contractors, and they were treated as such by the Domino's pizza restaurant. Revenue said, okay, the Supreme Court rather looked at there was an umbrella contract which they signed up to, and then there was individual contracts for each episode, we'd say, of work they carried out underneath this overall contract. Revenue said, okay, I keep saying Revenue. When the Supreme Court looked at this overall, they said, right, based on the overall fact pattern here, this meets all the characteristics of an employer-employee relationship, and so they reclassified them as employees. The next step then is finally it should be determined whether there is anything in the particular legislative regime under consideration that require the court to adjust or supplement any of the foregoing. So this is saying, if legislation deems deems that the relationship is either one of independent contractor or employee, well, then this obviously would take or should take precedence over case law, and this is generally, I suppose, the legal principle that case law legislation would generally ultimately have authority over case law. So this as I said, this guidance is significant. I think it runs to about 50 pages plus with examples. The examples, you will note from our feedback, we sort of have had some certain we have a different view, perhaps, to the extent of certain examples. I think one of the key ones, which will sort of explain the sea change here, is in the context of a guest lecturer. So the suggestion is now, if someone, so you know, you can use this example perhaps and extend it to other types of work. But if I take a university scenario where I'm running, say, my accounting course, and I ask, say, I invite Jeremy in to do a guest lecture. Well, now that arrangement will be subject to payroll. The extent to which you know, the guest lecturer will be entitled to broader benefits of the employer-employee relationship, that does not necessarily follow the tax designation. So, you know, you may well be considered payroll for tax purposes, but it does not necessarily mean that from the broader legislative agenda that you will have access to the other benefits of being an employee. But certainly from the employer's perspective, they are now liable for the tax, which previously obviously would have, or if that guest lecturer was considered an independent contractor, that the independent contractor will obviously be liable for the taxes. So that's one example there where you will see, I suppose, the ideas coming in about control and direction and lack of substitution, really leading to a conclusion from revenue that, you know, that such a person would actually be subject to payroll taxes. There is a slight distinction, and people working closely in this area will be aware of, you know, necessarily being considered an employee versus being subject to payroll. And this is why we're saying, I suppose, just because you're considered the employee for tax purposes, it may not necessarily follow that it's wider. So, you know, I'm sure there are loads of questions about this. I think the key thing here is, you know, to, I suppose, get familiar with the Carshan case at a high level anyway. This guidance, it is robust guidance, it's detailed, and you really will get a good sense of where revenue's thinking is. One positive, I think, that does certainly come out of the guidance, and there are other positives. Again, such detailed guidance is always welcome, regardless of maybe our initial response to it. But as I say, detailed guidance is always welcome. But the guidance does allude to the fact that if I'm operating through a corporate and I engage with another corporate, well, generally, if I'm invoicing through a company, revenue will accept that that's an independent arrangement. So there's sort of almost, I wouldn't say full presumption, but the tendency now will be, if I'm operating through a company and I engage with another company, in most cases, it seems like those scenarios will be accepted by revenue as independent arrangements. I suppose, look, you can follow that through, because at least if it's a company engaging, well, that's all going to ultimately be subject to payroll in the you know, the contracting companies. So that is welcome. You will find that in the guidance as well. So look, I'd encourage you to read the guidance. I'd also encourage you to review our feedback and our representations on it, just to get a sense of the level of work we are trying to do. We've engaged extensively with our members on this. And we have, as I say, provide detailed feedback. So there's quite a body of work being done on this to date. So just also want to mention briefly next on the EW, so conscious of time now, so look, I'm just going to give a quick 2 minutes on each of these. So just on the EWIS guidance, so this is the guidance on relief for investment in corporate trades. So this does cover SURE and SAI, and so the broader corporate tax relief as well. But I think EWIS is, at least in my experience, the most recognizable of them, and arguably the most common. There was an error whereby the date on the face of the manual changed from April 23 to May 24, but there were no actual changes to the manual. It was just would you say an admin change from revenue, because the time had come for the guidance to be updated, and I think there's an automatic renewal process that led to the date being changed. They are working on the guidance now. They continue to work on the guidance to implement the Finance Act, 2023 changes, and we're expecting that to be a copy of that to be provided to the Talc Direct and Capital Taxes Subcommittee in the next couple of weeks. And again, we'll have a chance to review that, and it should issue shortly thereafter. So just to say that guidance is, the work on that is ongoing. And lastly, just to give an update on the talc process, I suppose the talc process is how we get to engage on the revenue guidance, certainly on the employment status of workers, on things like EAAS guidance, and where we get to bring matters, administrative concerns to revenue as well. And this is one of the, I suppose, more important forums where we do represent you and your interests and the interests of your clients and the businesses you work for. And I suppose generally, the level of engagement changes depending, I suppose, on the particular topic and what we're looking at. At the moment, we're doing an awful lot of work around territoriality. So this is something we've lobbied for a while. Not just us, but the Institute of Tax and various sort of business organizations. Things like the Tax Foundation, the OECD, the Commission on Taxation and Welfare have all recommended that Ireland move away from a system of worldwide tax credits on foreign income to a system of exemption. So as anyone who's carried out detailed calculations under Schedule 24, this is the double tax credits, they're quite complex calculations. And often, 90% certain is pretty good to get this, because sometimes there can be interpretation concerns. The key thing here is that if you move to a system of a participation exemption for foreign dividends, is what they're officially calling it, it simply means once you meet certain conditions, you just did the dividends exempt from Irish tax. So we've been meeting. We put in a detailed response to the strawman proposal back last month, and we have met with revenue twice to discuss, I suppose, the direction of travel, and we're expecting another strawman proposal, a second strawman proposal on the legislation. I think in the middle of July is what towards the end of this month, start of July, with a response time to the middle of July, just to allow time for government to consider the proposals. So that will be, I think, a very exciting piece of legislation, certainly for businesses with investments overseas and any company just looking to maybe do a bit of work overseas. We think it will benefit SMEs for the reason that you will not have to worry about detailed double tax credit calculations. So it significantly addresses concerns around tax risk, especially when investing overseas. What we're explaining to revenue at the moment is that this should be an automatic opt-in as opposed to an automatic opt-in as opposed to a need to opt-in, if that makes sense. So what the strawman proposal suggests that businesses should tick a box if they want the exemption to apply. So one thing we're suggesting is that an exemption will generally be preferred to taxation. So the default should be, once the legislation is implemented, the exemption should apply in the first instance. And then if companies wish to apply the old double tax credit system because it is more beneficial, or they have credits coming forward, or they wish to pool credits, or some of these things that go on, well, they should be given that opportunity. So look, conscious of the time there now, so that's just I suppose they're just some of the key matters I want to discuss. As I say, the key takeaway from today: read the Carshan guidance, at least to get a sense of the general direction of travel. And there's a significant number of examples there, and you will find something that will relate to your business. So look, as always, Jeremy, thanks for the opportunity to come and update the members on the tax works.
Thanks, Gerard, for that very comprehensive overview again. Yeah, I know with the talc, there's always a lot of ongoing work. And definitely that I've read some of the examples there, and I know a lot of good guidance there on and practical guidance too on that employment status as well, a very complex area. So look, thanks for all that. As ever, I'd say there'll be a few questions coming in, so hopefully you can stay with us for the next while, and we might have you if you're still around at about 12 o'clock, if there's any key themes or different things emerging from it there as well. So Gerard, thanks very, very much.
Thanks, Jeremy.
Well, listen, I think for our next segment, Conal, we have the recording of yourself and Damien.
Damien, it's great to have you on. What's been going on in the market since we last met, Damien?
Well, Conal, it's been a very interesting time. I suppose we had a very strong first quarter of the year, and then, you know, as we were talking the last time, markets had started to correct a little bit. They continued to correct in April and then recovered in May. So we're pretty much as we were from a market perspective, as we were when we last talked about it. Really, I suppose where we are looking at the markets is that we're in an environment where economic growth is looking more positive than people expected, given the high interest rates that we've had for quite some time, which were brought in to bring inflation down. We're in an interest rate cutting environment. We still expect a couple of rate cuts this year, but probably fewer and probably slower than certainly were expected earlier in the year. What that means, I suppose, in the background also, so we have, you know, economic and market indicators a little bit undecided as to directionally. Some still coming through strong, some coming through less strong than they were previously. That's not something that you're particularly concerned about when you got, inflation, say, coming down. You wouldn't be very surprised that it doesn't come down just in straight lines. So it's not particularly concerning. From here, we're looking and saying, well, you know, what's going to happen now? We've got a very uncertain geopolitical environment. Obviously, we've got a lot of trouble still going on in Gaza, although hopefully over the last week, the initiatives are going to lead to a little bit of calming of that. We've still got a war going on in Europe. And the biggest thing we've got on is political uncertainty across the world. You know, elections coming up in the UK, in Europe, and obviously the big one from a global perspective in November in the US. So that's a lot of uncertainty, and we expect a lot of volatility to come through in markets. We're looking at people that have cash really should be making sure that they're getting returns on those cash. The rates are still quite high at the moment. You can earn good returns on cash and bonds. That's likely to start being eroded as rate cuts come through, albeit slowly. And really what you're looking at is if you have money that you need to get productive returns on, you should be looking at what is your strategy and easing into it. A volatile time is not the time to dive into a strategy of maybe high equity growth or growth assets, but start to ease in and look for opportunities to buy. So really, again, be clear on your objectives. Allow some buffer when you're looking at developing, implementing plans, and then, you know, make sure that you have a plan that empowers you and informs you and empowers you that when you get opportunities, you're not reacting badly. You're reacting in line with your plans. Again, I suppose maybe back to harp back on the stuff we talked about when in April when we were talking about Daniel Kahneman. Key really, to have someone you trust, get some advice, bounce from somebody, someone who likes you but doesn't care about your feelings again, someone who has your interests at heart, but will give you the good and bad news all the time. And so that really, that's what I would say where we are in uncertain times. Make sure that you're on a steady ship and know where you're going.
Sound advice. And so just at a very baseline, people who have money on demand deposits accounts which are giving very low interest rates now will give even lower interest rates going into the future, we'd expect, and it's going to be harder, I would imagine, to get good returns on money. So you really have to be thinking now about what your strategy is.
You're looking for opportunities, and really you should. There's no way that people should have significant amount of money still on deposit with the mainstream banks in Ireland. Certainly the online banks will give you better returns than that. And if you come to an advisor such as ourselves, we can help you get access to money market returns, which are still delivering north of 3% and likely to stay that way until significant amounts of interest rates come down, interest rate cuts come through. So you should be earning 3% plus on cash. And if you have a medium-term strategy, you should be looking to get more than that as you move.
Absolutely, and I guess good news for borrowers also if interest rates are coming down. It's
indeed.
Anybody who's on any sort of a variable rate loan of any kind or a tracker loan, indeed, if you're looking at one of those, it's going to be good times in due course.
Certainly anyone on trackers will be benefiting from it, and people on variable rates. I suppose you have the old competition and supply demand dynamics still working in the Irish market. So again, the more people shop around and look for either that be deposits or look for competitive good returns on the deposits or competitive rates on their loans, then the more reactive the participants in the market will be.
Absolutely. Okay, so interesting times. Damien, as always, it's great to talk to you, and look forward to you coming on next Practice News to keep us up to date as to where things are going and what to be thinking about next. So thank you very, very much, and talk again soon. Take care.
Thanks, Colin. Look forward to it. Anyone with any questions, of course, as ever, you know where we are, and reach out, and we'd be delighted to help.
Absolutely. You've got the details for AccuVest there at the end of the program. Thank you very, very much.
Thanks, Colin.
And we'll get back to our next item now. Thank you.
Thank you very much to both Conal and Damien for that piece there. Conal, I'm going to just ask you to actually be uploading the slides again, as I say to you, if you could, there, for our next piece with Orla and with Dee. And guys, hopefully you can, I don't think you can see me, but hopefully you can hear me anyway. And you're very, very welcome, Dee and Orla. How are you this morning?
Very good, thank you. Thank you, Jeremy, for having us. Won't do my usual technical update. Many people may be saying, thankfully. So today I am here with Orla O'Brien, and Orla O'Brien is an assistant principal at the Department of Enterprise, Trade and Employment, and she looks after audit and accounting matters. So we're really happy to have Orla here. She's very busy at the moment. She has a myriad of regulations sitting on her desk, the top of which is CSRD implementation. So welcome, Orla, and thank you for taking the time.
Thanks, Dee, and thanks to you for inviting me today. I hope participants will find something of value in my presentation.
Absolutely. Well, thank you. Well, just before we get into that, just to talk to you about, I suppose, particularly EU regulations coming down. I was at an event a couple of weeks ago where Frances Fitzgerald MEP spoke, and she was saying between that and when Parliament ended, they had 29 regulations that they had to get through. And I suppose it just gave a sense of the amount of stuff that's just really coming out of Europe. And obviously a lot of that then comes down to Ireland. Do you want to just give us a sense of what happens when you have an EU reg such as the CSRD, which has to be transposed into Irish law, please?
Yes, so really the audit and accounting area is very much driven by EU law, and I suppose that that's not a surprise because the EU is, amongst other things, a single market project. So the process is quite long drawn out. I mean, in terms of CSRD, for example, I probably first heard about it in 2020, when the EU Commission would do their background work. So they do an awful lot of work in the background and consultation and developing the impact assessment and data gathering before they brought forward the proposal in May 2021. Then it was negotiated and finally entered into force in 2023, and we have until July 6th, 2024 to transpose it. So, but none of that, if you like, is done in an ivory tower. I mean, certainly from our point of view, we reached out to our stakeholders as soon as the proposal was published in May 2021, and we had a stakeholder webinar. And then again, we're reaching out quite regularly in our process of transposition. So it's possible really at any stage of the development of proposals to find information, if you're interested, on the Commission's website in a great level of detail, including, you know, drafts of the proposal as it goes through the stages and as it evolves. And I suppose we're very strong on that, certainly in this division, trying to keep stakeholders informed so that they can have their opportunity to have their say and influence the proposal. I mean, it's important that Ireland, you know, really kind of represents itself at the EU and has its voice heard as a small member state. That's particularly important to us.
Yeah, absolutely. Well, thank you. And I know just even from our interactions with yourselves that you have engaged really really extensively on the CSRD in particular. So thank you for that. And, hopefully that helped you, and hopefully that will make what is a complex directive somewhat easier when it is transposed. So thank you. So just on the CSRD, then you have a few slides you would like to talk us through. So I'm going to share those now, and we can get to it.
Thanks very much. So I'm going to do a short presentation on the Corporate Sustainability Reporting Directive. Really, this is the EU's response to the global reframing of company reporting to include sustainability reporting. And by way of background, I suppose, as I said in when I was talking to Dee earlier, the genesis of EU proposals, they're quite long and quite deep, reflecting the amount of thought that goes into them. So the whole proposal for a corporate sustainability reporting directive would first have really appeared in the context of the commitment in the European Green Deal. So that's the EU strategy really to transform the EU into a modern, resource-efficient and competitive economy with no net emissions of greenhouse gases by 2050. And then as a related commitment in the EU Action Plan on Financing Sustainable Growth, and that's really about reorienting capital flows towards the most sustainable investment opportunities. So the Corporate Sustainability Reporting Directive entered into force in January 2023 after a period of just less than 2 years of negotiation amongst member states. So I'll move on to the next slide, please, Dee. Thank you. So the key information, essentially, the Corporate Sustainability Reporting Directive is going to require annual reporting by companies on sustainability matters. So they are environmental, social, and governance, including human rights matters. The reporting is underpinned by new European sustainability reporting standards that have been adopted by the European Commission, and they were developed by EFRAG, which is formerly known as the European Financial Reporting Advisory Group, but now known by its acronym. And developed really, again, it was quite an accelerated process, but it was independent and expert-led, as you would expect from a standards project. Directors of the companies are responsible for ensuring that the sustainability information is prepared in accordance with these new standards. And the information itself then is reported in a clearly identifiable section in the director's report. The reporting is on a double materiality basis. This is really very much a unique concept to the standards that exist in the sustainability field. And essentially, you're looking at impact materiality, so that's the impact of a company's operations on sustainability matters, looking out, and financial materiality, kind of looking in, if you like, what is the impact of climate, social governance matters on the company's operations. And the reporting must include the value chain. Although there is an exemption for the first 3 years from having to report on the value chain, I suppose in light of the fact that this is a new requirement and looking down the value chain is going to be an entirely new project and require a lot of work on behalf of the companies. There is a requirement that the information is going to be audited, or assured, if you like, is the term that we're using, to make a distinction, because it is going to be a limited assurance opinion initially, and it's going to then progress to reasonable assurance in due course. So I suppose of interest is always who is actually in scope. It is all large undertakings. I used undertakings here. Really, all large companies. Undertakings is the way the EU describes companies in its legislation, and public interest entities. Now, public interest entities is an umbrella EU term comprising banks, insurance undertakings, and listed companies. They're regarded as the sort of systemically important in an EU context, so they get their own special term. The only SMEs that are actually in scope of the rules are those that are listed on a regulated EU stock market, excluding micros. So not even the listed micros would be included. And I suppose we sort of tend to think of them as small, large companies because they are listed, and with the listing brings a lot of obligations. In due course, subsidiaries and branches that are large in the EU, that is with the turnover of greater than 40 million, and that are subsidiaries of a non-EU company that has a significant amount of activity in the EU, i.e. a turnover of greater than 150 million, must submit an equivalent sustainability report at the level of the parent. But that's a sort of, that's at the end of the phasing in, which I'll talk about shortly. So the EU estimate about 55,000 companies will be in scope, ultimately, compared to 11,000 under the current rules for non-financial reporting. In Ireland, we're estimating between 2,000 and 3,000. Just to say, just for extra precision, the definition of large is the definition that's contained in the Companies Act, which itself comes from the Accounting Directive. So that's turnover of greater than 40 million, balance sheet 20 million, and employees more than 250. So any of those 3 will bring you in scope of the new rules. However, as I said earlier, it is a phased implementation in light of the fact that reflecting really the fact who's been doing reporting up to now, and that companies will need some time to prepare to implement the new rules. So the deadline that I face is very imminent to make sure that the directive is given effect in national law by the 6th of July 2024, and fully focused here on achieving that deadline. Then for entities in scope, it's really, in the first year, it's the largest public interest entities that have more than 500 employees. So they will be doing their reports for this financial year, 1 January 2024, and then publishing those in April. So that will be, I'm sure, of interest to many people. I understand most of them will be published in April, if not all. And then the next phase is probably the most significant jump in a way. So that'll be large companies and the remaining large public interest entities, and they will be reporting on financial years commencing 1 January 2025. And then the listed SMEs, they will start from 1 January 2026, but they do actually have an opt-out. It's their choice opt-out until 2028. And then the large subsidiaries and branches that I spoke about with the non-EU parents will be reporting after 1 January 2028. We have engaged, as Dee said, extensively with stakeholders, and we have some advice, some, if you like, beginner's advice. And the first thing really is assessing whether you're in scope directly or as part of the value chain, as I mentioned. And then really taking that starting point, determining, the existing position, and really looking at reporting processes, internal controls, and governance. We certainly recommend discussing the directive and the standards with any advisors that you have, and also really, if you think you're captured by the value chain of a large company you're working with, start the conversation to find out what this means. As I mentioned, those companies will have a 3-year exemption, their own choice, from reporting on the value chain. So it'd be good to know what they're doing in terms of that. I would imagine that even if companies are going to exercise this exemption, they'll still be doing work in the background. And then evaluate, obviously, your ability to capture the data. Then I would recommend looking at the government supports available to assist companies. I was just reminding myself of what's there this morning, and the LEOs have some excellent and highly relevant supports for companies that are starting on this journey, especially small companies, with up to 50 employees. So that, and then the supports kind of flow on from that in sophistication as you move through the journey from starting out just simply getting a baseline as a small company to, things like accelerated capital allowances for energy efficiency measures and so on and so forth. We have a landing page on preparing your business for the Corporate Sustainability Reporting Directive, and that will kind of be a jump off point for further information. So sort of recommend having a look at that. There is a toolkit as well I haven't mentioned here, but you'll find that on the department's website, and it's particularly geared towards small companies just starting the journey. There are really an awful lot of supports out there, and really I suppose the challenge is looking at what's going to suit at what different part of the journey. So I might just finish up now. As Dee said, communication, that's really what we knew we'd have a difficult time really with the very short transposition period of 18 months in terms of making the legislation available ahead of that deadline, because of the amount of time it takes to really put together your legislative instrument, essentially. So what we focused on instead is being as clear with stakeholders as possible about what's going to be in the instrument. So as I said, you'll find information on what the shape of the legislation on our website, and we've had a number of webinars in the department. We have a kind of an umbrella group called Responsible Business, where we try to bring together a lot of these different environmental, social and governance type legislative either proposals or things that are at different stages of the journey. So most recently I think we had a webinar on the 14th of February, and there are more in the pipeline. So again, if you look at our department's website under Responsible Business, that might be of interest. Working on the legislation really intensely with this keen eye on the deadline of 6th of July. And then also there are some other developments. So, in a way we can't, while we're really focused on making it to the 6th of July, the second half of the year has to be planned for as well. But we have maybe probably three things that I'd like in the kind of EU context. So firstly, when CSRD is transposed, the next step that we want to take is to focus on supporting companies in implementation, and particularly SMEs. So at the EU level, there's some voluntary standards being developed aimed at SMEs, as well as some standards for the listed SMEs. So they should be finalised by the end of the year. And I think that's the Commission's firm intention. So we'd like to do some communication on that in the second part of the year. Another small piece of, I hope, good news is that very shortly we hope to be in a position and have publish the legislation transposing the increase in the thresholds for companies under the Companies Act. So they've been increased by 25%. I understand from the figures that we've looked at, that's going to be particularly good news for small companies that will become micro companies, so there'll be a consequent reduction in the financial reporting burden for them. A small number of large companies may fall out, therefore, from the obligation as well to report under CSRD, but I think the biggest impact is going to be at the lower levels. So look out for that in the next few weeks, and we'll publish it on the website. Maybe the third item, not necessarily EU related, is there is a companies bill in the very, very advanced stages of preparation and finalization. So keep an eye out for that. That contains the proposed changes to the audit exemption, such that the audit exemption would only be lost if in the case where a company files late two times in 5 years, as opposed to currently the kind of the current rules, which is just one. If you fail to file on time, that the audit exemption is lost. So I think there's sort of some good, very good legislation coming down the line that's going to assist companies. So my final recommendation is to sign up to our mailing website on CSRD at enterprise.gov.ie, because we will transmit not just the CSRD information and updates, but we also, because it is related, keep you updated on the threshold changes as well. So thanks very much, Dee. I hope that was of interest to the audience.
I think Dee might be on mute still, but Orla, thank you very, very much. It's great to have that overview. And you mentioned there, I think 2,000 to 3,000 Irish companies, and most of them large companies, and you're right, large isn't so large. And I know when we think of small practice here, I think, oh no, CSRD, a lot of people say to me, I'm not sure will that be for me. I think virtually everybody here on the webinar may have a large company as a client. So yes, it will be for you. And as you said, Orla, 2025 into 2026, and you mentioned reporting deadlines there. I think for the 24 guys, they're looking to report by April 25. So when this comes, it'll be fairly quick, as I say. So I think everybody needs to prepare and look ahead and see what clients could be impacted. And I think and we have a webinar coming up on this actually, so an in-person event in late June. I suppose the trickle down effect of suppliers, different things as well. So it's great to have those insights. And I know you're working behind the scenes to get that into Irish law, and also the audit exemption and the company size thresholds. We hopefully will see movements in that over the coming months as well. A very busy agenda for you and the team in DETI. So thank you for taking the time to be with us this morning. Dee, back to you.
Yeah, well, that's it really. Yeah, thank you, Orla. I mean, I think it's really interesting to hear the amount of supports that are there. I did have a look at your website before we come on, and particularly for SMEs who are trying to get on this journey. And as you say, I do think that is really important. A lot of large companies may avail of the 3-year exemption in terms of going out to their value chain. But I think for the time for SMEs is to try and start now, because there's a fair bit of information in it. And so if you can at least start on that journey, I think it will be great. You mentioned the voluntary standards for SMEs. Again, I think they're very useful. They were sent out by EFRAG to be consulted on. We did respond to them. Overall, I think for SMEs, they would be a very good option in terms of just starting on their journey and then complying with larger companies. So, so thank you for that. So we might share, when we send out the slides, we might just share some of the links actually back to some of your slides, some to your website, just so everybody has it, which is great. So thank you very much, Orla. I mean, I know from my engagement with you over the last number of years, I think we're so lucky in this country to have you guys who are looking at the legislation and who just engage so extensively with stakeholders. So thank you very much.
Dee, Orla, thank you very, very much, guys. Conal, I know you're looking totally confused there. My internet dropped, but very timely when it dropped, so that was okay. Conal, if I can say to you there, I think you're up next or you have the slides to get back for us.
I'll do that. But just before we go, and Orla, just while you're there, I don't know if whether time is allowing us to take any questions, because there's a few there have come in for yourself, Orla. I don't know if we can do that, Jeremy.
Perfect. Yeah. No, let's go with it. Yeah.
Just one. Will a large company with 31 January year end have to report under CSRD for 1 month of their 2025 year? I would think not, but no.
No. Apologies if I wasn't clear. It's just the obligation to report for financial years. It's in the director's report, so it's in line with financial reporting and so on and so forth. So no,
okay,
I can be definitive about that. I never like answering the technical questions on the fly, but no, I'm happy to answer that one.
No, and indeed, if you'd rather, if there's any other questions, it's as we can answer them. Once again, for yourself, Orla. You said that the definition of large is the same as in the Companies Act 2014. This includes ineligible entities. Now, I think we're talking there about central bank regulated entities. Is that the?
Yeah, exactly. Again, I'm happy to answer this question. There's two public interest entities is the umbrella term, and we're going to be using the definition of public interest entities. Ineligible entities is a bit broader, and that is in so that's used in the Companies Act. But the companies, just to be clear, in the companies reporting, if you like, in 2025, will be public interest entities. So the banks, insurance undertaking, and listed entities that are large and have more than 500 employees.
Absolutely.
So I hope that's clear.
There's one sort of nuance to it. Going forward, when it comes to a point when large companies in general have to report, I think there is a degree of, or there was perhaps a degree of concern that would include the companies which are sometimes very small. Insurance brokers, for example, would be one, because they're considered to be large in company law at present because they are regulated by the central banks of their Schedule 5 companies. I think they've been specifically excluded from the definition of large companies for this purpose.
Yeah.
I think Dee yourself, myself, had a conversation about that previously.
So there are a couple of there's a couple of carve outs, and I'm just thinking off the top of my head, these things like captive insurance companies have certain carve outs from various things, but I couldn't speak too specifically to the Schedule 5. I know you're talking about Schedule 5 in the Companies Act. That's something I just prefer to kind of just take a bit of time over answering.
Not to worry at all. Not to worry.
But there are carve-outs. You're right, and designed to make sure that the rules are proportionate, as you're saying, Conal. It's about proportionality.
Indeed, I do recall things like credit unions and charities that would be in this. And I think both of them are outside the remit of this. If I recall correctly, Dee, you might have a better knowledge than me, so I'm not 100% as well.
Yeah, absolutely. And I guess we are waiting on the final transposition of the CSRD also. But yeah, that's my understanding.
Okay,
Indeed.
I won't jump the gun then. And one final question, which I expect is also possibly unanswerable, is when is it expected the new companies bill will be enacted? Or I think that's back to yourself. If
it's being worked on intensely, as I understand, suppose it'll be over. It's being finalized, as I understand it now. So it should be available. I think it's part of the package of things I mentioned, that the detail by the summer, people should be able to see our legislation, the SME thresholds, and the bill which will contain the audit exemption.
Thank you very much.
That's a lot to happen in the coming weeks.
Certainly is.
That's why we're so busy.
And one final question is simply thank you, Orla. So that's an easy one. Thank you very, very much. I'll echo that, and I'll back to yourself, Jeremy.
Thank you for me as well to both yourself and Dee. And yes, indeed, keep your eye out on e-news, our own bulletins, and our own. When we hear of moves on those areas, company size thresholds, audit exemptions, we of course will communicate to our members. And also we'll build into, of course, our webinars and so on as well in the autumn time. So we'll keep you informed as soon as we hear any white smoke from Orla and from government and so on as well. So listen, guys.
Sorry, Jeremy, yeah. I might just mention one last thing which just might be useful. A number of the large companies around Europe have done a dry run of some of the CSRD requirements into their 2023 annual reports, and they have been collated on a website. So I might actually share the link with that. I think there's some of them are actually very good, but for anybody who wants to see how the larger companies are looking at the CSRD, I think it certainly might be worth looking at some of them. So I will share that link.
That is great. And just to say to you as well, I know we had some people asking about the versions of slide decks and different things to get links, particularly to Gar Roads material. I dropped about 20 minutes ago into the chat function the most recent version that we have of this presentation, including Gar Roads links, including the links to the upcoming practice professional standards slides as well. So if you go in there, you should be able to download that and have that version. Well, listen, guys, moving onwards, busy show as ever. Conal, I know you're diligently in the background there working away on the slides next with our professional standards colleagues. and I'm delighted to be joined this morning by Anne Cullen and Karen Flannery. Ladies, welcome back to Practice News. I know you've both attended with us on a number of occasions in the past. Hopefully all is well with you both.
Thank you, Jeremy. Lovely to be here. Thank you for the invitation.
Likewise,
Indeed.
Jeremy, very, very happy to have the opportunity to share updates with practitioners this morning. So thanks, Emil, for having us on.
And yeah, delighted to have you. And I know, just like with the Department of Enterprise, very busy times in professional standards. And you'll be a familiar face, I know, to many of the attendees here, particularly if you have an audit practice. And I know you're going to talk with us now about, I suppose, some of the changes over the years with relation to monitoring visits, be it audit, be it money laundering, which is one that's becoming more prevalent in both jurisdictions, and also some of the key findings and repeated themes you're seeing. So Anne, if you're good to go, we'd love to hear about that.
Absolutely, Jeremy. Thank you very much. Conal, I think you're moving my slides. Is that right?
Yes, I am. Anne, so just call when you want the next slide.
Great. Yeah. Well, if we can go on to the next one straight away. Thank you.
I think
I thought it would be useful, as Jeremy has said, I'm sure many of you know me and are quite familiar with monitoring visits in general, but I thought no harm for anybody who is a little bit new to it, just to talk a little bit about our approach, etc. initially. So basically, as many of you will be aware, we have a number of visit streams as such. We have anti-money laundering, we have audit, we have investment business, and we have practice monitoring. Practice monitoring typically covers non-audit, it covers clients' money, all of those other areas of the practice. When you're selected for a visit, you might be selected for one of these areas as a standalone visit in its own right, for example, an AML only, an audit only, etc. Or in some cases, we do combine the visits. So we might do anti-money laundering and audit. Really, it depends just on timings, on the circumstance, on how much we believe there is to cover in the visit, etc. So just to be aware that even though we have distinct streams, sometimes they will be combined just for efficiency, really, as much as anything else. In terms of visit selection then, and how we select the visits, in all cases, visits are selected on a risk basis. But coupled with that, we also have statutory cycles, particularly in the case of audit. So the maximum cycle for audit is 6 years, but that's not to say that you will only get a visit once every 6 years. And that's something just to be aware of, that oftentimes people query or sometimes even become a bit concerned as to why they're getting a visit sooner than the 6 years. As I say, there's a risk-based approach. And even if you have had a good outcome of your previous monitoring visit, that's not to say that we won't go back sooner than the 6 year cycle. So just to flag that to people, if you get notification from us before 6 years, don't be concerned. You know, the 6 years is the outer limit for the visit. In terms of the visit format, since COVID, we have adopted I suppose, a range of approaches in terms of visit format. So we typically operate three approaches. We'll either do what we call a hybrid visit, which, well, I suppose if I start, we'll either do an on-site, a remote, or a hybrid. So on-site is exactly as you would expect, and is the approach we would have done pre-COVID, where the inspector goes out and visits you in your practice, and the visit takes place face-to-face. Remote, we do mainly using Teams. Meetings will be held via Teams. Files will get delivered to the inspector. The inspector will make arrangements with you in terms of the logistics for that, etc. And the visit is conducted off-site. And a number of visits we find, and more of them actually increasing, we're doing on a hybrid basis, where we find we're getting efficiencies from working off-site, from using Teams, but in some instances, it's just appropriate to go and meet you face-to-face. So we do a mix of both. We do some of the work on-site, and some of the work we will do at your office, and that's what we term a hybrid visit. When you receive your visit notification letter, it will indicate to you which approach we intend using. But as I say, once the inspector gets in touch with you, then they will talk to you a little bit more about that and explain that to you. So if we could have the next slide, please, Conal. So it was really just to highlight some common issues on anti-money laundering visits that we are seeing. And I suppose the first point to make is, generally speaking, we do see a reasonably good level of compliance with anti-money laundering. We do see that in very many cases, firms have up-to-date policies and procedures. So I suppose it's just a reminder to make sure that you do have your policies and procedures up to date. And one reasonably common issue that we do see in relation to policies and procedures is, just bear in mind, your policies and procedures manual should specify who your money laundering reporting officer is. In some cases, we see that isn't actually spelt out in the manual. So do just have a look at your manual and make sure that that is covered in that. In terms of CPD, obviously just make sure that you are incorporating anti-money laundering training into your CPD and that training is up to date. Another common issue then in relation to client verification, we very often see client verification documents on file, but we don't always see that they have been certified as true copies. And we would expect that the money laundering reporting officer in your firm would certify, because obviously all that's on the file is a photocopy. So we would just expect to see a certification that you had actually seen the original documents. Whole firm risk assessment should be performed on an annual basis. This risk assessment should identify the services that your firm provides to its clients. It should identify the types of clients that you have, the sectors that they operate in, the geographic sectors that they operate in, and any geographic risks that might be associated with your client profile. And then finally, we would also expect to see an anti-money laundering compliance review performed annually. We sometimes see issues in terms of this review not being robust enough. So do ensure that it is sufficiently challenging, and it should include at least one cold file review where you have selected a file and gone through that to ensure that your policies and procedures have been appropriately applied. Where issues have been identified with anti-money laundering compliance reviews, we would expect to see timely remedial action in response to any issues that have been raised. We have the next slide, please, Conal. So the next one is in relation to audit monitoring visits, and I wanted to talk a little bit in relation to ISQM. As anybody who is working in an audit practice will be aware, ISQM is now in force for over 12 months. So it is now being reviewed on audit monitoring visits. And I suppose just in terms of this slide, what I wanted to demonstrate really is that ISQM is really a shift in mindset from ISQC1. And really, it is a lot more than just having an off-the-shelf package and just going through that and inserting your firm name into the manual. Really, it's an awful lot more than that. It's an iterative process. The standard is scalable for smaller firms, but even in smaller firms, we would expect to see evidence of how the firm has addressed each element of the standard, and certainly we'd be expecting to see that the firm has set quality objectives, that it has done a risk assessment, that it has developed responses to those risks. The communication piece, I appreciate in a very small practice, it doesn't have to be formal, but we still do need to see evidence that it has been communicated to other members working in the practice, and the monitoring and remediation needs to be carried out and documented. And the results of that, particularly where there are deficiencies that have been identified, we will be looking to see that you have then gone back and had another look at your quality objectives to see the impact of any results of your monitoring and remediation process on your quality objectives. So the process then almost starts again, which is why it's appropriate to have this circular diagram. In terms of monitoring visit inspections, as part of your pre-visit information now, we are requesting the results of the firm annual evaluation. So these given that the standard is now in for more than 12 months, these evaluations are due. So what we are asking for is for you to tell us the results of that as part of the pre-visit information. And then, as I say, when we go out on site or when we're doing our visit fieldwork, we will also be reviewing the monitoring and remediation process and how that is operating in your firm. Okay, I'll talk away anyway. The next one is in respect of RI CPD. Again, as many people will be aware, the IASA guidelines in respect of CPD are in for quite some time now. So RIs can be selected for CPD review either as part of the monitoring visit process or outside of that. We also select RIs for CPD review on a risk basis. You can expect, if your firm has been selected for an audit monitoring visit, that the RIs in the firm will be reviewed as part of that. But just to talk a little bit about what we are expecting when we are doing that CPD review. Really, I suppose this diagram just gives a bit of an overview of it. RIs are required to plan their CPD annually, and what we're looking for there is evidence that you've reflected on the knowledge and skills and the values required in order to enable you to do your job as an RI, and to identify learning and development needs and decide an appropriate CPD that would address those needs. We then would expect to see evidence that you have completed sufficient, relevant and appropriate CPD on an annual basis in order to meet those learning and development needs and to demonstrate achievement of the learning outcomes in Table A of IES 8. The next step then is to evaluate the effectiveness of the CPD activities regularly and to revise the approach as necessary. You're then required to maintain written records of your CPD, and those written records should include supporting documentation to evidence any CPD that you have undertaken. You're also required to retain those records for a period of 6 years, and that's in order to facilitate the monitoring of your compliance with CPD requirements. And then the final step is to submit an annual declaration confirming compliance with CPD obligations. Final reminders in respect of those annual declarations have been issued at this stage. If your declaration is outstanding, I would urge you to return it promptly, because ultimately, if they're not returned, your name will be reported to the Quality Assurance Committee for consideration. So I would just say to you, just get that in as quickly as you can if you haven't already. And then just to refer you, there is a CPD hub on the Institute's website. I've included the link at the back of the last slide in my presentation. So do have a look at that. It has a lot of useful information in respect of CPD monitoring. The next point that I was going to address is in relation to common issues arising on audit monitoring visits. And really, here we go, thank you, Conal. I suppose the first point, a fairly basic point, an old chestnut that we've been seeing for as long as I can remember, but do ensure that your audit procedures are up to date and that they are appropriately tailored to the client. We do still see some cases where out-of-date procedures are contributing to issues arising on the files that we review. Risk identification and assessment and ISA 315 requirements. We are seeing issues in respect of that on some visits. Bear in mind your risk assessments must be tailored, and the risks identified should relate to the audited entity. We see probably reasonably, I won't say reasonably frequently, but it is not unusual for us to see some of the procedures, some of the audit procedures have pre-populated risks, and we sometimes see that those have not been tailored on the audit files that we review, and in some cases the risks identified have no bearing whatsoever to the client. So just be aware of that. You know, don't just print off those procedures or apply them without considering them first, and make sure they're relevant to the entity. Fraud considerations, make sure your fraud considerations are evidenced on your file, and don't forget about considerations regarding management override of controls. Have a look at ISA 240 in respect of that area. It has detailed requirements on relation to that, and also addresses considerations for smaller entities in relation to that. So I would refer you to go and have a look at that. And professional skepticism and ISA 540. This is an area that we look at. The auditor needs to evaluate, based on the procedures that they've performed and the evidence that they've obtained, whether the accounting estimates and related disclosures are reasonable in the context of the applicable accounting financial reporting framework. What we don't always see on audit files in respect of professional skepticism is sufficient evidence of challenge by the auditor of the assumptions and the judgments and estimates applied by management. In many cases, once we have the discussions with the firms, they're able to tell us about the challenge that took place, but we do need to see evidence of that on file. And again, as I say, have a look at ISA 540. There are detailed procedures spelt out there, which are quite helpful as well in relation to that area. Go on to the next slide, please, Conal. It's just a few more points on audit visits. So I'll just keep, there we go, thank you. Stock take attendance. This is something that we are seeing really since COVID. It appears to be something that has reared its head a little bit. We are seeing quite often where people aren't attending stock takes, and stock is a material balance, and there is really no justifiable reason why the stock take hasn't been attended. When we query it, people are saying to us, well, it worked well over Zoom or over Teams when COVID was around, and we just haven't reverted back. That really is not an acceptable reason not to attend a stock take. The ISA does spell out that where stock is a material balance, the stock take should be attended. It talks about unless it is impracticable. So just be aware of that. Have a look at ISA 501, and if stock is a material balance, we would be expecting to see that you have attended the stock take and that you have performed reasonable procedures in terms of stock existence, etc. Audit of construction contracts, including long-term contracts and work in progress. We see issues there around consideration of accounting estimates, use of experts, judgments and estimates applied, etc. So again, back to your professional skepticism piece. But also we're seeing issues around appropriate accounting treatment. So just make sure where you have those types of clients that the correct accounting treatment is being applied. Similarly, auditing of investments and intangible assets, another area where we are sometimes not seeing correct accounting treatment. Bear in mind there things like impairment reviews and fair value considerations. Audit of related parties and associated disclosures, again an old chestnut, but something that we quite often see findings on. So just another area to bear in mind, and audit procedures on financial statements disclosures. And in relation to both the related parties piece and the financial statements disclosure piece, I would refer you to IASA have an inspection insight. We can go on to the next slide, Conal, if you wish, which is just the links. But IASA have last year, I think it was, issued an inspection insight on related parties. And they've also a thematic review, which they issued last year on financial statement disclosure and the audit and the procedures performed around those financial statements disclosures. Although that thematic review is based on IASA's review of PI audit files, really many of the findings do transfer to other entities. So I would urge you to go and have a look at that thematic review if you haven't had a look at it already. So that's a bit of a whistle stop of an update on our monitoring visits, but I hope it was helpful. Thank you.
And that was very, very detailed, and I'm sure of great benefit to anybody, be whatever practice you're in. Audit, yes, of course, but AML, of course, applies to everyone. And as I said, the visits are becoming a lot more prevalent. I know you have to leave us shortly, but before we go to Karen, I know we have a couple of questions in here. Some you may be able to answer, some not. We have one here asking about the AML compliance review of so there was a template of issued by Professional Standards with relation to with relation to your annual compliance reviews, be it audit or whole firm and so on, and they're asking for a review checklist. That review checklist, an up-to-date version, is now included in our AML toolkit. I'm sure many of you are users of that at the moment, so hopefully that addresses that for any user. Somebody's asking here, under ISQM1 UK, can a committee be ultimately responsible for the system of quality management as long as one member of the committee is an audit partner? And you may not have a definitive answer there, but I'd love to hear your thoughts.
Yeah, so I don't have a definitive answer, but the standard does require that the person with ultimate responsibility for quality, that there would be one person with ultimate responsibility for quality management, and that person must be a senior member in the firm. There then can be a different person who has responsibility for operational management of the system of quality management. However, if there are two people, the person with operational management must have a direct line of communication to the person with ultimate responsibility. So it really, I guess it would be up to firms how they wish to structure it, but those two roles must be in place.
Okay, that was my understanding as well. Conal, you've something to say there.
No, I was gonna park that because I think that's as comprehensive an answer as I could give. No, I was just going to move on to one more where I'll try and get the answer, and then you can tell me if I got it right. So the question is proof of home address required in addition to photo ID? And in this case, it depends whether you're talking Northern Ireland or the Republic. I know the legislation is kind of high level in both cases, and it says you need sufficient ID to identify the person. That's been interpreted in the UK guidance as being in low risk cases or normal risk cases that you don't need proof of address as well as photo ID. One documentation piece is sufficient. In ROI, the guidance is tipping you towards getting two pieces of identification in all cases. And I don't know whether that encapsulates what you're seeing and what you're applying.
That is something I would have to check, Conal, to be quite honest. I'm not entirely certain, and I wouldn't like to give the wrong answer to it. So I could take that one away and just check it.
No, okay, very good. Thank you very much. Okay, I think we've is that as many? Somebody asked how many firms are leaving audit each year. It's sort of a slow downward trend.
We're seeing, yes, we are seeing a fall off in audit registrations, but it is certainly not a cliff edge. It is a slight decline. We still have in the region of 600 audit registered firms. So yes, it is declining, but there are still a significant number of people involved in audit.
Absolutely, and I suppose your workload would increase now with CPA firms also coming on board into your remit. Somebody says, "Can I?" As part of the same question, can I leave audit before a monitoring visit? So presumably somebody has decided.
Well, if you receive notification of a monitoring visit, and if before the date the visit is due to commence, you have formally notified Professional Standards that you wish to cease your audit registration, then we may not proceed with that visit. But there would need to be formal notification provided.
Okay, very good. Thank you very much, Anne. Jeremy, I'll hand back to yourself but I think you'll probably move us along directly.
We will indeed. I will indeed. Thank you, Anne, for all those. Karen, I know you've been very patient there, and I know you've a lot of projects on the go as well. And as your job title, Head of Projects and Professional Standards, would imply. And I know you want to talk to us about some very important changes in indemnity insurance requirements, insolvency registration, and IB registration as well, investment business.
That's right, Jeremy. Again, thanks for giving me the opportunity to come on and share these updates with everybody. And I suppose I can get through things pretty promptly, because many of the items I want to bring to people's attention this morning have already been flagged through Institute publications, particularly Practice Matters and the Institute's Professional Standards Regulatory Bulletin. And I just take this opportunity to emphasize the importance for practitioners of reading those publications. They always contain very valuable updates, and they tend not to be too lengthy, and they also provide contact details for any practitioners who may have some follow-up queries or want to understand better what the changes are. So we always welcome that kind of engagement as well. Paul, if you move on to the first slide, please. First slide sets out the topics I just want to hit on very briefly this morning. The first I'll mention is a change to our policy in relation to investment business authorisation in the Republic of Ireland. And as practitioners know, the Institute is an approved professional body, which means that we can authorise firms to carry out investment business, and we can do so across a range of categories. There are 5 categories in which we offer investment business authorisation currently. However, a policy decision has been taken by the Institute's Council earlier this year to cease to offer authorisation in the highest categories of authorisation. They're known as IB2 and ID. And no firms will be affected by this change, because we don't have any firms who have those categories of authorisation, nor have we had for at least 10 years, and maybe going back further. And just to give people an idea of what activities are in those categories, firms that would have those authorization, and as I said, there are none, but those authorizations would provide authorization to undertake discretionary management portfolios on behalf of clients, and also the holding investment business client monies. So going forward, it will not be an option for the Institute to provide authorization in those areas, and our investment business regulations will be updated in due course to just reflect that policy, which is already in place. And that said, if there is a firm who is minded to want to engage in those kind of activities, it's not to say there's a prohibition on doing so or anything like that. The firm can, of course, go directly to the Central Bank of Ireland and seek authorization to provide that kind of investment business from the central bank directly. The second policy change that is important to bring to people's attention is in relation to our insolvency licensing regime. And I suppose the impetus for the change here is coming from developments in the UK insolvency regime. And for a number of years now, the UK government has been engaging with recognised professional bodies who have a regulatory role in the supervision of insolvency in the UK, with a view to how that regulation should be provided. And there was a significant period of time where the proposals from government were leaning towards the development of a situation where there would be a single regulator rather than a number of recognised professional bodies providing that statutory regulation in the UK. And then surprisingly last year, the UK government, when they finalised the outcome of the consultation and engagement that had been going on, concluded that they will continue with the recognised professional body structure of regulation, but that they would seek to have more regulation, if you like, offered by those bodies and reform to the system, including regulation of firms rather than individual practitioners, and then an independent standard setting system, and a number of other increased activities in that area. And so the Institute went from a situation of having an expectation that we would no longer be a recognised professional body because the model would move to a single regulator format, to actually being given more duties and having additional engagements. And given that the Institute only has less than 50 insolvency practitioners and insolvency license holders in the UK, it really has become economically unviable for us to continue to offer that to members. with any kind of a sensible sort of fee structure or whatever. So council has made a decision that we would cease to be a recognised professional body with that statutory role in the UK. And we have started the engagement with the relevant authorities to facilitate that. The important thing here is for those who are our members who are insolvency licence holders in the UK, because this is a statutory regime, it's still important for those insolvency licence holders to have statutory regulation and to minimise the disruption for the 40 odd licence holders in this area. We've had significant engagement with ICAW, and ICAW have agreed to transition those insolvency licence holders who wish to move to their regime and to do so as smoothly as possible. They have agreed a significant fee discount for the first year, and on an ongoing basis, they will be able to offer insolvency regulation at a fee which is lower than Chartered Accountants Ireland could possibly offer, given the small population that we regulate in that area. So there may be some disruption as the practitioners are moving over to the ICAW regime. However, we're going to work as closely as possible with ICAW and with individual licence holders to make that transition as smooth as possible. And licence holders will have had a letter directly from Professional Standards in that regard in the last week or so. And if there is any questions arising and so on, please do get in touch. Contact details have been provided in the context of that communication. And just to then balance things out, you know, it's important to mention the ROI regime as well. In the Republic of Ireland, insolvency regulation is somewhat different in that there isn't a statutory obligation for the Institute or any other body indeed to provide regulation in this area. So in line with ambitions to ensure that there's a level playing field both amongst other professional bodies in Ireland and also vis-a-vis our UK practitioners, the decision has been taken as well that from 2025, the insolvency licensing regime, which we do have for the Republic of Ireland, which is a voluntary arrangement for the Institute rather than statutory arrangement, that will also cease, and changes will be made to our public practice regulations in due course to facilitate that going into 2025. But that's not to say that insolvency practitioners in Ireland will be subject to no supervision. Members who provide insolvency services will still be required to hold an ordinary practicing certificate and can be subject to practice monitoring visits in the same way as any PC holder would be. The next topic to mention is sustainability assurance. We've had a bit of information from Orla at the Department of Enterprise, Trade and Employment earlier, and professional standards. We're keenly looking forward to seeing that transposed law, and I would reiterate the comments that Dean Moran made about the benefits of engaging with the department and how engaged Orla has been along the way, and even coming on this webinar today is just an example of that. However, we are keen to see the transposed legislation. We understand that the Institute will have a role in the authorisation of sustainability assurance providers under the CSRD. We are ready to provide that, and I've provided a link there to FAQs on the Institute's website. Now, obviously, authorisation can't be provided until there is law that underpins that, and we need to make the appropriate changes to our own regulations and so on. But we have been working on processes and procedures to facilitate that authorisation, and there are certain eligibility requirements and so on, and the authorisation can be offered to individuals who already hold RI status with the Institute, so they must be statutory auditors in order to become sustainability assurance service providers with the appropriate CPD demonstrated in the initial couple of years, or thereafter it will be practical training and examination. So more information on that is available on our website, but I would just flag that at this stage, given we still don't even have law, the Institute's activities will be focused on those practitioners who are seeking status as a sustainable insurance provider because they have clients in scope of the first wave. So we don't expect that to be very many, because as Orla explained, there really is only those very large pies in scope for the first year. So it is the sustainable insurance providers in relation to those that we'll be focusing on first. Just to make a brief mention of the imminent amalgamation with CPA Ireland, and you've all been aware of the vote on that, and recently members have voted to change bylaws to facilitate the moving forward with the technicalities of the merger. And at this point, we know that the amalgamation should take place in autumn of 2024, which is actually very, very close. So I suppose it's just worth kind of flagging to practitioners that there's no big change coming in that regard as a CAI practitioner. Probably the changes will be most felt by CPA members who are coming into the Chartered Accountants Ireland regulatory regime. So the regulations that Chartered Accountants Ireland practitioners are used to dealing with, and the professional standards team they're used to dealing with, they will continue as is. However, it's worth noting that the opportunities that come with the amalgamation are that we get to look at how another body is operating under the same legal framework that we're operating under, and to identify opportunities to simplify processes, to see are there other ways of doing things which can benefit members, and obviously some synergies as well from just working together. So I think over time, practitioners will hopefully see the benefits of that flow through. And the final thing I just wanted to mention is changes that are coming in professional indemnity requirements. And Colin, you could move on to the next slide there, please. And I have the kind of the key details of that set out. And for members who wish to look at the details, this information has also been flagged in the recent practice matters. And there is also a news item on our website which sets this out as well. And of course, I understand that these slides are available to take away for participants as well. But I suppose the key things are that the change in the minimum limit of indemnity is increasing somewhat. So going up to 2.34 million euro, or 2 million sterling. So somewhat of an increase there. And then for firms that have that smaller gross fee income, there has always been just a concession in that regard, and the amounts are changing there. So firms that have a gross fee income which is less than 936,000, now their minimum limit can be equal to 2.5 times that gross fee income, subject to the overall minimum indemnity being 290,000. So some change in the figures there. A new aspect of it is that, well, there's always been an allowance, if you like, for very large firms to have in place an alternative type of appropriate arrangements for PII, rather than having to meet the specifics of the qualifying insurance that's set out in the public practice regulations. And that used to be based on the number of principals in the firm. So that's changing to large firms with a gross fee income of over 58.5 million in euro or 50 million sterling. And those firms will not be required to have qualifying insurance as per the public practice regs, but they must, of course, have professional indemnity insurance arrangements which are appropriate to the size and nature of the firm. And then the last change to mention is in relation to the excess requirements. So firms that do have their qualifying insurance in place, the maximum aggregate excess that relates to those policies should not exceed the hire of 3,500 euro, 3,000 sterling, or 3% of the firm's gross fee income. And that excess used to be linked to the number of principals in the firm, but it was considered more appropriate that it would be linked to fee income going forward. So next slide there, Conal, just to wrap up, I suppose, just to say that the changes in public and the professional indemnity insurance are arising as a result of a review that was undertaken by the three chartered bodies. That's the Chartered Accountants Ireland, ICAW and ICAS. So the changes will be put through the regulations of all three bodies at the same time. So you will see it in the public practice regulations for Chartered Accountants Ireland. And the changes will be effective from the 1st of September 2024. So that means that any new policies taken out from that date or any policies renewing after the 1st of September 2024 should meet the new requirements. So policies that are currently running and will run beyond 1st September 2024, of course, that's okay for those policies to continue, but the next time the policy is being renewed, the new limits will be in place. So that is really all I wanted to draw to practitioners' attention this morning. And I hope I haven't gone over time too much. I'm happy if there are any questions to take them if I can. Back to you, Conal. Thanks, Emil.
Yeah.
Thanks very much, Karen. I'm just saying, do we have any questions? I don't think
I
we
actually
do.
don't see any questions, Conal. No. Karen, it was obviously all perfectly clear.
Or I ran over time and people are gone for lunch.
No, they're not.
Either way, it's okay.
We still have the vast majority of people here with us. So no, thank you for that. I know that if anybody does have any specific queries, of course, on matters like this, I suppose your professional standards, general professional standards at charteredaccountants.ie inbox is you can send in an email.
Absolutely.
And then the relevant member of the team would be happy to come back to you. Yeah, wouldn't that be the best
that's
idea?
right. That's very closely monitored, that inbox. Professional standards at charteredaccountants.ie. And the appropriate colleague will respond to any queries that come into that.
Brilliant. And yes, indeed, I know you've some details put in. So practice matters that'll be issued next week on this. And yeah, those PI changes, I know we'll be talking about them again in the autumn and so on as well.
Absolutely. And you very generously took a bullet there saying you'd gone over time, Karen. I don't think you did. I think
well, somebody did, Conal.
Somebody did, exactly.
That responsibility lies with me and Conal. But thank you, Karen. And hopefully you can stay on with us for if there is any more questions next few minutes and so on. Before we go to Leontia's tax update now, I'm just going to ask if Garrod is still there. I didn't see too many questions, Garrod. If you're not, as I say to you now, not to worry. Was there anything else that you saw coming in there? I think it was a very quiet tax session there. Perhaps Garrod isn't with us at all.
I am. No, Jeremy is here. Yes, sorry, I was just waiting to jump in. Look, I suppose there hasn't been too many questions beyond just people looking to link to the guidance, and that's positive because I think the key thing to take from today's presentation, just to reiterate, is to familiarize yourself with the guidance. And I would recommend, if you are, as I say, certainly if you're advising clients in this area, I would familiarize yourself with the Supreme Court judgment. It is lengthy, but the guidance does complement the Supreme Court judgment, but the Supreme Court judgment itself is obviously the key authority here, and it really explains, I suppose, it explains the case law in the area for the last I suppose 20, 30 plus years. It really goes into some detail. And I suppose this is now the precedent in terms of how we approach matters of employment status of workers going forward. And it's that judgment which has led to this new 5-step framework. And I suppose the thing is, in particular, if your business is engaged, if you're advising clients who engage independent contractors, or for those working in business who are engaging independent contractors, I strongly recommend that you discuss this with your advisors. And if you have in-house tax, certainly this is worth bringing this to their attention to raise it with clients. Certainly, I think the commentary around contractual arrangements needs to be carefully considered. In the initial draft guidance, I suppose there was a particular stance on contracts, but I suppose the new guidance does reflect, I suppose, our thinking around the position of a contractual arrangement. The judgment itself goes into incredible detail on when a court might consider setting aside, I suppose, the private arrangements of businesses, and it is quite a task, but nevertheless the guidance does set out how revenue are going to approach this going forward. So I think, if you are engaging company to company, I suppose that does seem, based on the guidance, to de-risk things to an extent. So that is positive, but certainly if you are engaging individuals, you do really need to consider the new rules. And I suppose, if there does need to be a correction, consider, that will be complicated. The judgment does discuss, it's at the end of the judgment, there is at the very end, there's a comment around allowance for taxes paid by individuals. I think that's a positive aspect of the judgment, which is worth considering. I suppose it will remain to be seen now how this guidance is applied, because it is new, and certainly, well, we would expect, I suppose, this guidance now to result in at least, some activity, and we haven't heard anything specifically about that. But just as a tax practitioner myself, that's what I would expect when such a new piece of guidance comes out. And so as I say, really encouraging you to take the time to read that, and as I say, to look at the examples. There's about 18 examples. So, even if you just go straight to the examples to get a sense of, I suppose, the scenarios revenue are looking at, and they do include a conclusion in terms of where they see, each of the examples has a conclusion, which is also helpful. So I suppose that really is the key takeaway from today. And of course, then, if you do have time, please do read our pre-budget submission. As always, this is the culmination of a significant amount of work by the tax committee. And it's, I suppose, informed by ultimately the asks and calls of members. So we hope that you, if you do take the time to read a document, you will feel that this does reflect your interests, and does, I suppose, keep the Institute at the forefront of the dialogue. So I suppose that's just the closing comment today, Jeremy. So
thanks, Gerard, for that very comprehensive overview. And I know, again, if there's anybody with particular questions, you've shared your email address there, the general email address as well for you and the tax team. And yeah, it's a very busy time, hopefully a little bit quieter over the summer, but I imagine the autumn again with budgets, it will be, both UK and Ireland will be a busy time again. So thanks, Gerard, for joining us today. Cornel, I think we're nearly there, as I say to you, for Leoncha's recording. I know we still have a good amount of people with us. I spot that there has been issues on downloading I tried to share a second slide deck there. All slides will be shared afterwards again in the email that will go out with the survey, and a recording will be early next week. We'll be sending all of that out, so just to make you aware of that. Okay, Cornel. Our next, I think, area is Leoncha's tax presentation. Emma, hopefully you're still there in the background, and basically,
hello, and you're all
share that with us. Thank you.
Very welcome to the third UK tax update for Practice News in 2024. I'm Leoncha Doran, the Institute's UK tax specialist, and as I mentioned in previous webinars, I have nearly 30 years experience working in tax. In this short recording, I'm going to provide you with a brief update on what's been happening since our last update in April, and what we, as an institute, have been working on for you, our members. So let's get going. So as you can see, this time around, the key themes I'm going to cover are what's been happening with Making Tax Digital, an update on some recent consultation work, developments in relation to HMRC customer services, and some other issues to round the recording out. So let's start with Making Tax Digital. Since the last update in early April, HMRC has now officially expanded the beta trial in 2024-5 and has been busy sending emails to agents providing information on how to sign qualifying clients up to the trial. As previously covered, we therefore as an institute continue to advise members to carefully consider both the advantages and disadvantages of participation in the beta trial ahead of the first phase of mandation from April 2026. We're also currently considering how best to support members in their preparations for this change, including looking at CPD webinars and support from HMRC, and we will also continue to attend HMRC forums on Making Tax Digital. But just to note that due to the pre-election period known as PERDA, HMRC has now suspended some Making Tax Digital forum meetings in the coming months. HMRC has also recently launched a technical consultation on proposed new regulations called the Penalties for Failure to Pay Tax Assessments Regulations 2024, and that consultation runs until the 10th of June. Now, these draft regulations relate to the reformed penalty system that will apply for late payment of tax, and that's in accordance with Schedule 26 to the Finance Act 2021. As many will already be aware, penalty reform began for VAT taxpayers from the 1st of January 2023, and it began from April 2024 for those participating in the Making Tax Digital Income Tax Self-Assessment Beta Trial. Now, for all other income tax self-assessment taxpayers, penalty reform will commence from April 2026 as MTD for income tax begins to be mandated. Just note that this reform penalty system, which is being consulted on, essentially is based on the fact that under current legislation, which allows HMRC to assess a second late payment penalty within a 2-year assessment time limit, HMRC is not able to assess this penalty if the tax remains unpaid. Hence, this consultation is looking at a proposed legislative change which will allow the second payment penalty to be assessed towards the end of the 2-year time limit, and that is in circumstances where the outstanding tax has not yet been paid in full. Essentially, this will mean that taxpayers will not be able to intentionally avoid a second late payment penalty by not paying their outstanding tax before the end of the 2-year time limit. Note also that a new manual on how to use MTD for income tax has also been published, and that is being regularly updated by HMRC. And also, since our last update in April, the number of available software packages for MTD from income tax has already increased from 5 to 7. And that already includes some of the big software players in the market. There's also a range of other software packages in development. Now let's look at recent consultation work. So firstly, 2 submissions have been made to government as follows since our last April update. The first consultation response was in relation to the call for evidence under the Tax Administration Framework Review, looking at inquiry and assessment powers, penalties and safeguards. The Institute's Northern Ireland Tax Committee highlighted in its response that when an inquiry has been opened, which is accompanied by an informal request for information by HMRC, a 30-day deadline is usually set for submission of that information to HMRC, with an expectation that this information is provided within 30 days from the date of the correspondence and not 30 days from the date the taxpayer receives the correspondence. However, as many of you know, often there is a delay in a taxpayer receiving the correspondence from HMRC, sometimes up to 14 days later. So this delay, coupled with ongoing resource constraints being experienced by tax agents and their clients, can make it very challenging to reply within the 30-day deadline, which is even shorter when correspondence is not received until much later. Now, once then the information is submitted to HMRC, often a response is not received back from them for several months, and in some cases we are aware that there have been delays of up to 6 months or beyond. Agents and taxpayers therefore feel held to account by being made to work to meet unreasonable deadlines and demands when HMRC is not held to the same standard. There's also inconsistency in being able to agree with HMRC a longer time period within which to respond to informal information requests. Some officers within HMRC do follow their own guidance in this area, but many do not. Please do have a read of the consultation submission in the tax representation section of our website, which includes a number of other recommendations. The Institute also recently submitted its response to the consultation in relation to raising standards in the tax advice market, strengthening the regulatory framework and improving registration, which we highlighted and discussed in our April update. By way of reminder, this consultation examines 3 different potential approaches to regulate the UK tax agent market in future. Not surprisingly, like many of the other professional bodies, the Institute's preferred approach is mandatory membership of a recognised professional body on the basis that members of Chartered Accountants Ireland would be part of a recognised professional body. However, the Northern Ireland Tax Committee's response also told HMRC that extra additional regulation of practising members of Chartered Accountants Ireland is not required. We've also recommended that there should be a minimum transition period of not less than 5 years to ensure that any future change is properly implemented, and so that the market is able to fully prepare and adjust. HMRC also needs to consider what transitional arrangements can be introduced once a decision has been made on the approach to taken. And finally, we also reminded the UK government of its commitment to level playing field as part of the UK and EU Trade and Cooperation Agreement. As normal, the committee's full response can be read in the tax representation section of our website. And whilst it's probably the case that this project will slow down given the election in July, it's quite clear from discussions from previous meetings with HMRC that this issue will not go away. And finally, the Institute will also be responding to the consultation on the introduction of the UK's Carbon Border Adjustment Mechanism from January 2027. That response will focus on the practical administration of this new regime and the need for clarification in relation to how the UK CBAM and the EU CBAM will work in relation to Northern Ireland, where businesses in Northern Ireland may potentially need to administer 2 different regimes. Turning now to HMRC services. So during our last update, we talked about HMRC's decision in March to halt permanent changes to its helplines after these were officially announced, and the reaction was quite severe. Now, before the dissolution of Parliament on the 30th of May, after that decision was taken in March, the Financial Secretary to the Treasury announced an additional 51 million in funding for HMRC to help deal with the pressures on its phone lines and improve declining service levels. Now, that announcement of this additional investment came just 2 days before the National Audit Office published a highly critical report on HMRC customer service. However, despite this additional investment, HMRC has made clear that it is essentially still working towards and does not affect its strategy to become a digital-first tax administration. And it is therefore, in its words, seeking cooperation and support on this journey from taxpayers and the professional bodies. Now, after this announcement was made in May, the Institute attended a bespoke meeting with HMRC last week, during which HMRC advised that it is working to source additional resource using this 51 million. This will take some time to be established and obviously to have the staff in place and fully trained. Therefore, we need to remind you that HMRC has previously made clear that despite this additional funding, quarters 1 and 2 of 2024-5 are likely to see a further decline in services. Overall, HMRC's longer term strategy is still to move most taxpayers to digital services. Now, at the meeting last week, we discussed and highlighted a number of pain points in the tax system, and in particular, we pointed out the lack of agent services for areas such as changes to tax codes. The Institute will continue to monitor this and engage with HMRC and the new government as it considers the way forward. And of course, as always, we welcome your feedback at any time on HMRC services. And finally, I just want to wrap up with a couple of other matters. First of all, just to remind you, as I mentioned earlier, we are in pre-election purdah, which means that many meetings with HMRC this month have been deferred. There is also likely to be an emergency budget after the UK general election on the 4th of July. But with the election taking place over what is close to the summer resource for Parliament in the UK, it is possible that any emergency budget would not be held until early September if it's not held in mid-July. HMRC has also asked us to issue a reminder to the agent community who are frequently targeted by criminals attempting to trick them into downloading malicious software or malware onto devices. Now, this software can give fraudsters access to agent tax accounts and, in some cases, of course, the personal details of clients. If malware is not completely removed, even after a password change or even after the creation of a completely new account, criminals can still retain access. So the advice from HMRC is to regularly ensure that any software used is up to date, check antivirus protection is switched on and is up to date, and take the advice of avoiding clicking links or downloading attachments in suspicious or unexpected emails. Now, if HMRC is concerned that malware is present on an agent's systems, it will act to protect its systems, with access to agent service accounts being potentially threatened and, in some cases, being removed temporarily. And overall, HMRC will be issuing a reminder on this to agents in its agent update in the next few weeks, but we are awaiting advice from HMRC on what agents need to do if access to their agent services account has been removed, which of course is quite serious and prevents you doing work on behalf of clients. So just a reminder that this recording is giving an overview only on what's been happening and key work streams. But remember, you can keep up to date with all the latest tax news, Irish, UK and international, and any developments through Chartered Accountants Ireland's tax newsletter that we issue every Monday. And there is a link to subscribe on this slide. And finally, just want to sign off with a thank you for listening. I hope you found this helpful and interesting, but please do get in touch if you have any further questions. Thank you.
Thank you, Leontia, as well. We've had one or two questions there for Leontia. The best thing, as she referred to in the last slide, is to contact Leontia. She works on different aspects of Institute work here on Mondays and Tuesdays is our primary days. That's why we have the recording here on a Friday. So if you contact Leontia by email, I'm sure she'll be happy to give you her thoughts on any questions you may have relating to UK tax. So Conal, we're nearly there. I know we have had a very packed show, a lot of questions, good interaction too, and it's been very interesting. Even jotting down a few points myself.
Yes. Well, look, I think we've dealt with the questions as they have come in. I can't see any questions there that haven't been dealt with, so that's great. I'd just like to say thanks very much to everybody who's helped us with the presentation. We've gone a little over time again, so apologies for that. But like I say, it's a big backroom team helping us get it to the place that it is. So we'd like to say thank you to all of those, the CPD team taking on the bookings and putting it in place. Emma for helping us through and keeping us right all the way through. Thank you very much, Emma, keeping us audible and visible. And to yourself, Chairman, for putting it all together. So I think with that, and to obviously all our contributors and all your participants, especially for your questions and comments during the show. So thank you very much, and we look forward to talking to you soon. Look out for Practice Matters magazine; it'll be coming out soon. And one person with one final question, getting one in there. Thanks. Someone saying thanks to us. We are much appreciated. Thank you very, very much. All right, we'll leave it there. Until then, look after yourselves. Have a great weekend.
Thanks, Conal.